Hello and welcome to the Banker's Tech Talk video series, exploring the world of fintechs. I'm Joy Macknight, Deputy and Technology Editor at The Banker, and I'm joined by two economists from the official Monetary and Financial Institutions Forum, Bhavin Patel and Pierre Ortlieb. Thank you so much for joining us today.
Pleasure.
So Pierre, I'm going to put the first question to you. Can you tell me a little bit about sort of the different attitudes towards crypto assets in different jurisdictions and how that's progressing?
Sure. Well, that's a very good question. And I think the starting point for that is to acknowledge that legal ontologies in general are very poorly equipped to deal with the nature of digital assets. What I mean by that is that you can assign a number of different categories to digital assets per se. So what regulators are trying to determine across the globe is whether they consider these assets utilities, securities, commodities, or some other kind of asset, right? So, and it's difficult to do that precisely because a lot of the different digital assets fall into different and sometimes to several different categories at the same time, right? So you have blockchain-based platforms like Golem, which are considered utilities, but regulators in the US, for instance, tend to regard more traditional cryptocurrencies like Bitcoin as commodities, right, which makes a little more sense. And so what you find is that there is a lot of uncertainty in dealing with these assets precisely because they are so difficult to categorize, and that's why regulators have taken very disparate approaches to it. So as I mentioned, in the US, you can go anywhere from commodities to utilities to even securities, so that's quite difficult. And as complex products around digital assets develop, like ETFs, it becomes even more complicated to adequately regulate them because the legal terms are difficult to apply, right? And then you have other jurisdictions, for instance, which have entirely banned the trading of digital assets, for instance, in China, whereas others have been more proactive. For instance, Malta are now calling themselves the blockchain island because they've taken a very sort of flexible, tech-first, case-by-case basis approach to digital assets. So it really varies. You can go anywhere from very favorable to an outright ban, and that has its roots in the fact that it's difficult to categorize these assets legally.
Okay, Bhavin, I know the central banks are also looking at crypto assets.
Yeah.
What sort of challenges do they foresee?
Well, as Pierre rightly said, it depends on how you categorize what a crypto asset is. So is it a currency or is it a security? And most central banks just don't see them as currencies at all. So it's not a medium of exchange. It's not a good store of value. It's not a good unit of account. So in the real world, you can't really buy anything with cryptocurrencies. So you don't see houses bought in Bitcoin or priced in Bitcoin. So there's always be a demand for sovereign fiat currency. I think where the big issue is when you see a lot of where the money's going. So the AML and KYC aspects of the whole system is what central banks are interested in. And coupled with some of the capital controls it might have, so especially China, I think they banned crypto trading because it was conflicting with some of their capital account restrictions. So it varies between that, and more so, I think central banks are trying to understand a little bit more about how to protect investors as well at the same time. So it's more about the education part and people knowing where the risks are and how different it is to an equity, for example, and people just seem to be piling in at the same time.
But it's interesting because the central banks are looking at issuing, let's say, their own digital currency. What are the challenges to that, or and what kind of opportunities could be seen?
Yeah, so central banks now have an opportunity to sort of issue their own token, which is denominated in a sovereign currency. So this eliminates a lot of the sort of usability issues that cryptocurrencies have. So once it's sort of priced in fiat currency, you can see that there's not going to be much price variation, and you can actually use it much better as an asset. The inefficiencies that you see in today's sort of payment systems is a big sort of motivation for central banks. So we did a report with IBM looking at the wholesale aspect and how we can use crypto sort of technology and blockchain to improve current systems. And this is especially useful for cross-border payments because the inefficiencies are larger there, and the chance of getting more efficiency and more utility out of what what a crypto token might be for a central bank is much better there. So you see a lot of assets being recorded on ledgers now, and the tokenization of assets, and that's something that central banks can look forward to. Because we do see a lot of bank-to-bank transactions just not being in cash only. So you see securities moving on different platforms, and the whole sort of efficiency gain there is quite large.
Okay, but obviously it would make a really big difference if institutional investors got into cryptocurrencies. What are the barriers for them doing that?
Well, first of all, I don't think it would necessarily make a difference to the manner in which central banks approach the issue. I think that's very much a sort of payment systems issue for them. But I think for the retail space around digital currencies, for consumers, I think the impact of institutional investment would indeed be sizable. And I think the primary obstacle that you see right now is based around the size of the market. So I mean two things by that. The first is that the market itself is still extremely small. The other is that there are concerns, I think, around how much computing power it would take to service the entire financial system if they were to record their transactions on a ledger, right? So that would take up a huge amount of energy. So those are the two size considerations. But I think also the regulatory uncertainty that we just spoke about is a huge boon, is a huge disadvantage to institutional investors, right? So I think ultimately all liquidity is legal, right? You want security of contract and things like that. And as long as that framework isn't there, not only at the national level, but also at the international level, where some bodies have taken steps towards regulating crypto assets, but not really significant steps yet. So you see IOSCO have done some work on this. Until that's done adequately at the global multinational level, I think until then we won't really see much institutional interest in the digital asset market. And that's, those are the three dominant concerns, but there are also others around sort of custody, storage, things like that. So really there are a number of barriers to be overcome. But at the same time, I think as we see complex products developing in this space, so I mentioned ETFs, but also the CBOE launched Bitcoin futures in the past year or so. So things like that, I think, are sort of steps that can be taken to introduce institutional investors into this market. But I think there are still barriers to be overcome until they really sort of dive headfirst into it. I think it's mostly dipping their toes at the moment.
Okay. Bhavin, Pierre, thank you so much for joining us today.
Thanks for having us, Joy.